Welcome to this video about NewDeal Invest's eToro portfolio called NDI-FutureTech. It'll also be about NewDeal Invest's way of investing in technology stocks. In this video, I'll give you a short overview of NDI-FutureTech, and then I'll talk a lot about what we do different, how we invest in tech in the right way, what we see as the differences, and how you can improve your tech investment strategy. First, briefly on NDI FutureTech. We are a year old now. We launched 1st of December last year, and we are up 65% in the first year. We have more than 40 positions. We rebalance every quarter. We only pick dominant companies. I'll get back to why. We pick from 200 best of breed tech companies. I'll get back to best of breed. And then we're long-term investors, but sometimes we have a position of 0% in a stock for tactical reasons. And diversification is really key, and I'll get back to a lot more on diversification. Now, the team behind NDI FutureTech, it's me. I know a lot about tech trends, strategic analysis. I know a lot about variance mitigation, also about value chains and disruptive processes. History rhymes a lot. I'll get back to that. Then we have Jordan Lambert, who's a CFA and a university economist. Jordan and Simon has a sell-side shop. They advise funds on tech investments. Jordan do fundamental analysis, classical portfolio analysis. Then he's an expert in cybersecurity, SaaS, and AI businesses. Simon is a tech nerd, has been that all his life. He knows the tech ecosystem. He knows who are the founders, who are the investors. And that gives us a great advantage because we always know which non-listed companies the public listed companies that we invest in are competing with. Simon is also a university economist, and he does fundamental analysis. And knows a lot about. He's a tech specialist as well as Jordan and myself, and as Jesper Beck. Jesper has a career from the gaming industry. He knows a lot about AI, simulation, rendering, gaming, metaverse, etc. And then we have Lauritz, our programmer. And Lauritz know a lot about mathematical simulation, helps me a lot with the variance mitigation, the under the surface stuff on the portfolio. Now, this is how we address tech investment, just briefly and broadly. We have the qualitative focus, and it's really about understanding technology. Where is it going? The larger picture. What are going to be the attractive trends and sectors? But also within each sector, you need to have an idea of where the margins are going to be. Is it going to be the open AIs of the world that will have the big margins, or is it going to be the cloud service providers, or is it going to be NVIDIA? And the future is always, you cannot tell, but you can have educated guesses on it, and that's a lot of where we try to differentiate. Yeah. Then we have strategic analysis. It's a lot about when the smartphones came, what can we learn from that? What can we learn from Microsoft not getting it right, but Apple understanding it? And it's all about this, that history rhymes, and disruption always is new, so you cannot predict it, but there are some similarities on which companies might get the competitive advantages in the long run. So there is a lot of general themes that you can use to make your educated guesses on the companies of today. And then we do quantitative analysis. We do all the things that classical management firms do. We do fundamental analysis, technical analysis, sentiment analysis. And then I think apart from the qualitative focus, the embracement of unpredictability and variance is really important for the results we've achieved so far. It's something about getting the math right, understanding it, and about a mindset as well. Now, the value add that we give to you investors is that we help you invest in upcoming tech. If you go back to the zeros after the dot-com burst, people tend to say that tech was dead in the zeros, but tech was definitely not dead in the zeros. We had Google, we had Apple, we had the internet companies just flourishing and growing up to becoming the next big companies, the FANGs and the Mac 7. So, so there is always new tech companies coming up. The past 10, 15 years has been an era where the winners have kept winning. So it's been a good time just to be passive index investing. But once you get a technological shift, you need to be aware that you might not see a continuation of the past 10, 15 years. Just like we saw a shift in the company landscape when the technology shifted from the PC era and then to the internet era, made new companies win. And then we help you diversify from the concentration that we currently see. So if you're an index investor, you'll have a lot of the Max 7, and we are much more diversified, and we don't have so much of the big companies. So we're a good diversification away from concentration that you see today. And then we invest in tech the correct way, and that's what I'll come back to. So if we continue to overperform, then it will be because of this third bullet that we do things the correct way. Now, actually, it's a new process. It's a new approach of tech investment, and I want to use the first principles framework for trying to describe what it is that we do. And first principles is about identifying what are the basics of the problem that you're trying to solve. Now, for suitcases. The problem that suitcases solve is that you transport stuff when you travel, and it's mind blowing that we didn't put wheels on suitcases before after we actually landed on the moon, and that's because suitcase designers just kept looking at what were last year's suitcases, and then we make a new iteration of that. And I think you could use that analogy when you think about tech investment because we're people are really good at investing in value companies, and there is a lot of frameworks and stuff for that has been developed over the past 50 years. But tech investment is actually different. So when you just take what the tools and the principles that you have from value investing and apply that to tech, you get a poor result. And that's actually our opportunity and what we're trying to solve and address in NewDeal Invest. And I'll take you through that now. So we'll first look at the opportunity, then we'll look at the problem, and then we'll look at the mathematics of the problem, and then go through our solution. Now, the opportunity is really simple to illustrate. The biggest companies of the world has always grown out of the latest technological wave. So in 1917, US Steel had a market cap of 2.5 billion, and that was because of the technological wave about heavy construction and engineering. Then in 67, General Motors was worth 25 billion, and that was because of the technological wave about combustion engines and the automobile. Yeah, and then in 1998, Microsoft became the biggest company in the States with 250 billion dollars, and that was because of the PC, the microprocessor. Apple in 21 because of the internet, and in 2040 we'll have a new biggest company in the States probably, and that will be an AI company, the winner of the AI era. I think Nvidia is a really good candidate for this, but you could see other companies coming in if history rhymes. And another way to see it, to illustrate the same point, is that here are four indices below in the bottom, you have the Dow Jones, and it's a little more than 10 years, 180%. You have S&P 500, 247%. You have Nasdaq 403%, and then you have the Bessemer Venture Partners Cloud Index, and that's an index of upcoming cloud companies that Bessemer Venture Partners has been running. And you see the overperformance here. You also see that you get a heavy drawdown in younger tech companies in 2022, and you got one during .com, you got one during the great financial crisis in 2008, and now we got one in 2022. So every time pessimism comes in, then you see these heavy drawdowns in younger tech companies. But you also see the long-term overperformance here. So the more techy, the more growthy an index is, the higher the performance. The less mature companies you have in an index, the higher the performance, at least when you compare these four indices. And that's the opportunity that tech outperforms and has always created the most value. Now, that begs the question, why is tech not more popular amongst investors? And it's really simple. It's because tech comes with unpredictability, and it comes with variance. And that creates low performance in portfolios due to variance drags. And that's here comes my point about you cannot take the framework that you use for value investing and then just apply it to tech, because tech has higher variance, and that creates variance drag, creates poor performance. Now, the value investors try to solve this by calculating by using volatility as risk, and that way trying to keep high volatility stocks out of the portfolios. But yeah, then you need to remove Nvidia from your portfolio. So it doesn't make sense, and that's really the issue here. I'll just briefly go over the mathematics of the problem to give you a feel of what the problem here is. And it's best done with an example. So if we play a coin flip game, and let's say we win 50% when we get heads, and we lose 33% when we get tails. So we could do an expected return math. We could say we win 50% or $50 if we're paid with $100 every second time, and we lose 33%. That's $33 every second time, and that means that we get on average 8.33% return from this game, and that's the red line here on this figure here. Now, if we do simulations where we play this game just through time, we just play, we actually end up with these results. These are simulations, and they average on 0% return. And if we do the math here, it's easy to see that we get 0%. So if we win 1.5 times, no, if we win 50%, that's 1.5. And then if next time we lose, that's 33% down, that's 0.67. 1.5 times 0.67, that's actually 1. So we get 0 return. Now, if we simulated this enough times, we would see that on very rare occasions, we get an extremely high return on these games. And so the average of all simulations, if we do an infinite amount of simulations, that would actually be 8.33%. So the variance drag is actually that the most likely outcome is poor, and the good outcomes are rather rare. And that's the math behind you see funds underperforming indices, because they create more variance by doing a narrower portfolio, and then the most likely return is below average, whereas once in a while you get a fund that creates an above average return. So we do things different here. We try to reduce the variance to get to look like the indices outcome. Now, let's try to play with variance. So if this is our example up there that gave us 0% in geometric return and 8.3% in theoretic return, arithmetic return. Now we could narrow the outcomes, and then say instead of 50 we only win 40%, and then instead of losing 33 we lose 23%. That doesn't change the arithmetic return, but it changes the geometric return. Suddenly we get 8% in geometric return, and if we do it even narrower, reduce variance, we get 13% in geometric returns. On the other hand, if we increase the gap here, we see that geometric return deteriorates. So the most likely return deteriorates, and we get a very rare, really, really good return. So once in a million years, we'll get a good return, but the most likely is a poor return. And that's actually what we are interested in, is the most likely return. So we see that when variance go up, our geometric return goes down. So value stocks or bonds would be going this way here, reducing variance, but going to tech stocks would be this going this way here, increasing variance and thus decreasing the geometric return. And that's why tech stocks overperform, in my opinion, because variance is mitigated poorly, and that means that you need to have a bigger discount on the tech stocks compared to the risk reward that they actually create if you think about it arithmetically. So this graph here shows you the median returns, the most likely returns. The game we're playing here as simulation is that each month we get 0.5% return on our investment, and that means that we get 6.2% in a year and 82% in 10 years. And that's if the variance is 0%. So each month we get 0.5%. Now, if we do things like they are in the real world, we don't get 0.5% each month unless it's a bank account or a bond. But companies and markets make variance. So some months are good, we get more, and some months are bad, we get less. And so there is variance on the returns, and we can see that that actually reduces. The higher the variance, the lower the medium return is. And once the variance get very high, we actually get to negative median returns on our investments. So it's the same here. Increasing variance diminishes the geometric returns being the real life returns. So from that, we can conclude that we need to tackle volatility when we invest in tech stocks. And now there are two types of volatility. There are historic volatility, which you can be measured, and that's what the market focus on. That's what the market calls risk. So if an investor thinking classically would think about what are the risks of investing in Nvidia today, he would look at the chart past 2 years and see how much is the price going up and down. That would be the risk, and it doesn't make sense to me at all in practical investment. The risk about investing in Nvidia would be, what are the risks of a cyclical downswing? What are the risks that demand wanes for a shorter period, a longer period? What are the risks that big tech is able to compete by producing chips? What are the risks of AMD getting a competitive chip? Stuff like that. That would be what I would be thinking about, and that's long-term future volatility. That's actually the volatility that you need to address, and that's what our setup focuses us on. And actually, the market is relevantly lowering share prices when future volatility is expected to be high. This is the expected risk-adjusted return on the stocks in our portfolio. And by risk here, we use what the stock market usually use, the historic volatility. And you see that the ones that has the highest expected risk-adjusted return, i.e., is the cheapest when you use the past fluctuations, share price fluctuations as a risk parameter, that would be companies that has a high future risk. dLocal has a short report out. Cisco is a kind of a turnaround company. Supermicro Computer has a an accountant issue, could be a potential semi-fraud, something like that. PDD is a Chinese company. What will the Chinese administration do about PDD in the future? Mercado Libre is operating in Latin America, has 50% of the revenues in Brazil, so it needs to be cheap, right? Compared to Amazon, which is it's just the winner in the States and has huge moats. Nvidia also, these companies here have good moats, good management, good financial situations. Not talking about lemonade there, but yeah. So the market is actually getting the thing about future risk. It's priced in. Yeah. So if unpredictability and volatility are the physics, how do we do the best job investing in technology companies? We need to do something different because a 30 stock portfolio is just a poor way to accommodate tech stocks. And we need to invest in tech the correct way. And actually, we need to have a lot more focus on mitigating variance and reducing unpredictability in our portfolio. That's our main job as tech investors. And we first let's look at mitigating variance. So simple way is just to have a lot of positions, because if we're long-term investors, the risk of investment is not whether the stock fluctuates a lot, because when we're investing for 10 years, we don't see that. It doesn't matter what the share price of Nvidia has been during the 10 years. It matters what it is in 10 years. So we mitigate, and we call that's what people call idiosyncratic risk, based on the company itself. How does the company fare in the future? So we do that by having a lot of positions. That's just a no-brainer way. And the more positions you add in, the more you, the better you mitigate that idiosyncratic variance. You can also do something with qualitative analysis of the diversification. You can make sure that you don't have too much revenue or too much cost in one geographical area. You can make sure that you have a variation of diversification of maturation state of the biz. You can make sure that you're well diversified across different sectors, across vulnerabilities of the stocks, across opportunities of the stocks, etc. So it's qualitative analysis of the stocks that and the diversification that you obtain here that matters. The other thing you can try to do is to reduce unpredictability, or what I call idiosyncratic variance. And a really good way to have a lot of idiosyncratic variance is to choose very young companies with a lot of debt and an unproven technology or solution to what they're trying to achieve. So we go the other way. We look for companies that have the leading technology. So this term Bob means best of breed. So we don't want to invest in the cybersecurity with the second or third best technological solution, because that will increase the risk of them failing over the next 10 years. We want to invest in the company that has the absolute best solution to the problems they're trying to address. That's the best of breed business, because that technological advantage will probably enable them to survive for many years, and to thrive for many years. They'll probably have the best employees, etc. Now, the gorilla term here is about getting investing in the biggest company, the strongest company within the sector. So again, if we go for cybersecurity, even if a small company with a lot of debt has the best technological solution, we wouldn't invest in it. We want the companies to be large and to be to be durable, to have a lot of resilience over what might come. Also, very important that they have a good balance sheet, because if something unexpected turn up, a competing company starts reducing prices, something like that, you just have a bigger resilience. And then there's all the other stuff that you can think about once you start thinking about how to reduce unpredictability. but these two are the main or the most important factors. So the value adds that we add to you investors is that you get to invest in upcoming tech. If you look um, at the zeros, you wouldn't have been invested in Cisco or Sun or some of these because they are not they were stalling in their growth there, but there was a new technological wave which was the internet, which was upcoming, and there were some champions of the internet that was upcoming. That was the Googles, the Amazons, etc. We would also have invested in eBay because we wouldn't have been able to tell whether Amazon or eBay would have won. But yeah, that's good enough. Then we will give you diversification from the concentration that we currently see today. Many investors have a lot of big tech in their portfolios, a lot of Max 7 from their pension plans, from funds they're invested in, from index investing. So we will give you a diversification away from that concentration. And then, as the third thing here, we invest in tech the correct way, and that I believe will unlock great value. So if we continue to outperform over the coming years, that will be because of the third bullet, which was the thing I talked about lastly in this presentation. So yeah, so that's NewDeal Invest. And you can go to NDI-FutureTech on the eToro platform to look us up there. You can see our portfolio. You can see on our wall, you can see our analysis, our updates, videos like this. We have a Q&A session every once in a while. And where you can ask questions about the companies that we invest in. So yeah, follow us and yeah, hope to hear from you on a Q&A session later.